Let's practice with the sales return and allowance. As we discussed in the class, we will set up some sales return allowance and AR allowance for return based on the past experience of certain percentage of sales would be returned. So these two contra accounts should be established if we have past information. So let me read the question. ABC sold the goods of $2 million to customers on accounts during June 2008. According to the past experience, now we have information. The 5% customer will return the purchased item within 60 days of sales, and 3% of customers will return within 180 days of sales. So the company has a return policy, and that has some past information, the return behavior from the customers, 60 days and within 180 days. So up to June 30, 2008, 4% of sales have been actually returned. So we set up the 5% customers within 60 days, but up to June, within 30 days, now 4% out of 5% has returned. So let's generalize the sales and return transaction and then pass this transaction into the balance sheet and income statement. First, sold the goods of $2 million on accounts and total 8% sales return expected. So now we need to set up. Before setup, we need to recognize accounts receivable $2 million, and then sales actually up on the credit $2 million. So we have information total 8%, 3%, and 5% would return. We have the past information. How do we set up this percentage? Again, this is percentage of this return policy is estimation, provision. It's not yet determined. It's not yet decided. It's not yet happened, right? It's not yet happened. So we needed to use some contra account that reduces sales, and also a contra account that reduces accounts receivable. So let's reduce the sales return allowance. Allowance means estimation. We just allow our customers to return like 5% within 60 days and 180 days 3%. So that is the allowance, but it can be different in the future because that information delivered from the past behavior, right? But we know what happened in the past, so we set up this allowance to make the balance sheet and income statement more realistic. So the sales return allowance from sales times total 8%, 60 days and 180 days. Also, we set up AR allowance, accounts receivable allowance for return. The same, 2 million times 8%, exactly same. Okay, so why don't we put this journal entry into the balance sheet and income statement so that we want to see the changes on the balance sheet and income statement when we create this journal entry. So here we start from AR and then sales, 2 million, and then sales return allowance. Here we go. So that is the contra account that reduce the sales corresponding account, a company account. So that's why I wrote in red. And then AR allowance for return, also the contra account that reduced AR. So it is negative like this. So the sum of these two is account receivable net. That is the journal entry and posting on the balance and income statement on the selling of goods on credit, and 8% sales return expected with provision. Now, 4% sales have been actually returned upon June 30. Now, how do you adjust this the transaction? Do you put just the sales because we reduce the sales? No, we do not put the sales account right away because we have another contra account that reduces sales. Yes, here we go, the sales return. Now that is already happened. It's not sales return allowance. Now we recognize that actual sales returned. Actual sales have been returned. So how much is that? The 4%. Now 4% of sales has been actually returned. Now we can reduce AR directly because you cannot get $80,000 out of $2 million. Not cannot be the collected. So we reduce now the same amount like this. Then we have had AR allowance for return 160. The reason why we had set up this the contra account is that we expect that amount is going to be returned, right? Now that is the set aside amount. That was the temporary account until it realized, right? So we reduce this accounts receivable allowance for return by 80,000 because now out of 160,000, 80,000 is realized. So here we have to reduce this account by 80,000. Also, sales return, we have set up the sales return allowance because it is provision. Now it is realized. We have to write off this amount by recognizing sales return, also by recognizing accounts receivable on the credit. Then we don't have this amount no longer, 80,000 out of 160. So the sales amount, here we go. How much? Sales return allowance. So the same amount. You guys got it? Then let's put this journal entry into the balance sheet and income statement. Sales return, now we have sales return minus, that is contra account of sales. And then AR, now we can reduce minus 80,000. AR allowance for return, AR allowance for return. Now we increased 80,000 because that is negative account of the asset. So plus 80,000. So do you see? Allowance for return now has been reduced to $80,000. We still have accounts receivable net 1,840,000 because we reduced AR by 80. Also, we reduced the allowance for return by 80,000. The same value reduced in positive, in negative. So the AR net doesn't change, and not AR net doesn't change. What about the sales return allowance? Here, sales return allowance has been recorded on the debit side because that is the contra account of sales. Now, we should reduce this negative amount by 80,000 because we haven't reduced. So here, now the net sales is sum of this. So assuming that we don't have any other expenses, so net income is equal to the retained earning, and that we matched out. Okay, that's it. See you in the next video clip. Bye bye.